Hi, my name is Dan McLaughlin. I'd like to invite you to a presentation on the Irish housing market as it stands in January 2015. Irish house prices peaked in the middle of 2007 and subsequently fell by around 50% across the country, with the decline in the capital even larger at almost 60%. Nationally, though, the market bottomed out in March 2013, and since then we've seen a recovery in prices. As the chart shows, prices have risen 27% from that cyclical low, and the latest data, which is November 2014, national house price inflation was over 16%. One result of the house price appreciation, of course, is that the numbers of mortgages in negative equity has significantly fallen. That figure probably reached over 300,000 in 2012, but as the chart shows, the significant price appreciation, particularly in 2014, means that it now looks as if the numbers in negative equity has probably dropped to around 130,000. The improvement in the Irish property market also extends, at least to some degree, to the figure for mortgage arrears, although it is still extraordinarily high by international standards. But it does look as if the percentage of arrears in terms of personal dwelling homes did peak in the third quarter of 2013 at 12.9% of outstanding mortgages, and the latest figure shows 11.2% in arrears. Unfortunately, the buy-to-let sector still looks as if it has yet to peak. Arrears there are continuing to rise in percentage terms, and as of the third quarter of 2014 had risen to over 22%. A range of studies, including a number by the Irish Central Bank, suggested Irish house prices probably fell too far, and the valuations, particularly at the bottom of the cycle, looked relatively cheap on fundamental grounds. We can update that kind of analysis, taking on board the fact that house prices, of course, have risen over the last 18 months or so. Now, here we look at house prices relative to three fundamental measures of value and looking at the long-run average. As we see in the first one, affordability, which is the cost of a new 25-year mortgage relative to income. If we look at that metric, Irish house prices are currently still well below the long-run average, going back to 1975. If we also look at house prices relative to an income measure, again going back to 1975, house prices still look around 11% below the long-run value. In terms of rents, the divergence is much less pronounced, of course. As you can see, the current level of prices isn't far off the long-run average for rent. So on that basis, on two of the three measures anyway, house prices certainly don't look overvalued. In this chart, we take a closer look at that affordability measure I mentioned. As I noted, in this case, it is defined as the average payment on a new 25-year mortgage relative to income. So it takes account not only of obviously of the change in household income, but also mortgage rates, and in particular the average size of a new mortgage. And it is that latter figure which is largely responsible for a very significant improvement in affordability over the last 4 years. Over the very long run, going back to 1975, a new mortgage takes around 28% of income to service, and the current figure on my estimate is down around 22%. So it's well below the long-run average. So on that basis, affordability is certainly not an impediment for any improvement in the Irish housing market. In this chart, we look at the change in national residential rents as picked up in the Irish Consumer Price Index as measured by the CSO. Rents fell, of course, substantially during the downturn, but bottomed out earlier than prices, bottomed out around the early part of 2011, and since then have been picking up, and particularly over the last 18 months or so, the appreciation in terms of national rents has been quite substantial. The latest figure is showing rents rising around 9% year over year. So on that basis, for the last few years, it has implied that we have had a tightening demand-supply balance in the housing market. The fact that house prices picked up nationally does mask quite a divergence, though, between the experience of prices in the capital and elsewhere. As I noted earlier, Dublin prices did fall faster than the rest of the country, but also prices in Dublin have bottomed out earlier. And this chart shows you the annual change in prices in Dublin and the rest of the country. And you can see pretty clearly that Dublin has significantly outperformed in the last 18 months or so. In fact, our Dublin house prices have recovered by 46% from the low, whereas in the rest of the country, the rise is only around 13%. The fact that house prices in the capital city tend to be substantially higher than the rest of the country is not a unique feature to Ireland, of course. It's a common feature across most countries. But in this chart, we look at Dublin versus the rest of the country. And as you can see, during the boom, we had a massive premium on Dublin prices. They were about 65% above the average for the rest of the country. And then during the downturn, as we noted earlier, Dublin prices fell faster, and consequently that premium declined very sharply to around 20-25% at the bottom of the market. But again, over the last few years, we've seen Dublin house prices outperform to the extent, indeed, that we're, in terms of relative value, Dublin prices were something like 70% over the average for the rest of the country. So at least on the data that's available at a fairly extreme level. Indeed, the pace of house price appreciation in the capital has prompted a number of commentators to voice concern about a possible bubble developing in Dublin housing. That's an interesting question, and to answer it, we've had a look at some of the characteristics of a bubble and see how they apply to the Dublin situation. The first characteristic is that we need to see rapid price appreciation, and that is certainly present. As we noted before, we've had a 46% rise in Dublin house prices over the last couple of years, and the current annual inflation rate of prices in the capital is over 20%. So we can certainly put a yes in that column. A second characteristic of a bubble is that people expect prices to continue to rise. And again, we can tick that column for Dublin because all the surveys suggest that buyers expect prices to increase again in 2015. A lot of bubbles are also characterized by excessive credit growth, but that's certainly not the case in the Dublin situation. As we'll see, net mortgage lending in Ireland is still contracting, and it would seem that over 50% of transactions, housing transactions, are being driven by cash. So we'd have to put a no in the credit column in this case, because it certainly doesn't seem to be at all a factor in the house price gains we've seen in the capital. And then finally, I suppose the most difficult thing to measure is the price of the asset out of line with fundamentals. That's difficult to establish in a lot of asset markets. And one of the arguments in housing is that one should compare the price of a house with the rent one can receive from renting it out, on the basis that the rental market is not prone to bubbles. Rents determined by there's a lot of buyers, a lot of sellers. There's not a great expectational element in it, and nor is there a credit-driven element in it. So it's a better fundamental measure of the underlying demand and supply for housing in a given location. And on that basis, if we take the average rent for a house as, say, reported by daft.ie, and discount that by an appropriate discount rate, for example, the mortgage rate, the current mortgage rate, you arrive at a house price which is a little bit above the current asking price for Dublin Housing. So on that basis, we can say that house prices are certainly not significantly out of line with rents at all. So on that overall basis, we've got a mixed result. In terms of the price gains, we've certainly has some bubbly characteristics, but in terms of the credit side and relative to fundamentals, I would say it's difficult to say there is a bubble there at the moment. Any analysis of house price inflation in Dublin must also take account, of course, of the supply side of the market rather than just concentrate on the demand side. Because it is pretty clear, I think, that there is a significant imbalance that has emerged over recent years. We know from the 2011 census that there was a fair amount of vacant property across the country. But we also know from that census that the vacancy rate, particularly in South Dublin, was significantly lower than the national average. And since then, there's been very little house building across the country, and particularly in the capital. This chart shows you the number of completed units in 2011, 12, 13 and 14. And the first 3 years, you can see that the total was less than 1,500 units a year. By units, we mean, of course, actual houses and apartments. So we've also included the figure for completed houses, which is substantially less, of course, than the total. In 2014, we can see an increase in supply, quite a pronounced increase, at least in percentage terms. We now have figures to the end of October, and that suggests that, that shows that we have 2,700 units completed in the capital, and that of that there's over 1,100 actual houses. But to put that into context, a range of recent studies have been consistently pointing to the need for something of the order of 7,500 housing units a year needed in Dublin. So clearly the supply, although it is picking up, is substantially below that figure still. So it's pretty clear that in the absence of a demand shock, house prices in the capital are likely to continue to rise. Turning now to the mortgage market, we can have a look at developments there. First thing to look at is new lending for house purchase, and that's certainly collapsed during the downturn. For example, at the peak of the boom, there was 110,000 new mortgages for house purchase drawn down. That collapsed to just over 11,000 at the bottom of the cycle. It's clearly illustrating, I think, the results of both a collapse in demand for mortgages and significant problems on the supply side of the market in terms of the banking sector. But what we've done here is to show a 4-quarter moving average of new mortgage loans for house purchase. So this is the actual amount of new mortgages given out. And you can see the trend is now started to rise again. So clearly there is some improvement. Demand is picking up, and the banks are in a better position to supply some additional credit. We noted earlier that this recovery in housing market has certainly not been associated with a significant increase in credit, and that's very clear if we look at this chart here, which shows total residential transactions as captured by the property price register. What we've done here is simply added to the chart the number of mortgages for house purchase drawn down in each quarter. And you can see that the blue bar is certainly substantially below the total transaction figure. And in fact, over the last couple of years, from that data, it would appear that mortgages are accounting for less than 50% of total transactions. That's very low relative to the normal experience. If one goes back over the past decade, perhaps a figure of 80–85% in terms of transactions driven by mortgages would be a more common figure. So clearly there is an unusual feature of this cycle, and as I said, there's far more cash buyers driving activity than the norm. We've seen that mortgage demand is certainly not the main driver of the recovery, but clearly one would expect to see mortgage demand pick up from here, and the data does suggest that that is the case, particularly as some of the fundamental drivers of mortgages, which are usually employment growth and income growth, have started to turn positive for Ireland. In this chart we see GDP and employment, both of which have been indexed back to the end of the previous boom. And you can see that GDP bottomed out actually at the end of 2009, but that the recovery initially was very slow and uneven, but in the past year has picked up a lot of momentum. We had very strong growth in the first half of 2014, and on average the economy appears to have grown something of the order of 5% last year. We are also beginning to see a little bit of a pickup in domestic demand, although consumption has remained quite soft, but most people expect domestic demand to show a little bit stronger growth in 2015. But I think particularly for the mortgage side of the market, what's crucial is we have seen a significant pickup in employment. Employment was slower to bottom than GDP, but in the past 2 years we've seen a fairly steady rise, particularly in fact in 2013 we had 60,000 jobs created through the year. That pace of job creation has slowed in 2014, but nonetheless is still rising. So higher employment means higher incomes in the economy, and we would expect that to translate into further increase in mortgage demand. One reason I think why consumer spending in Ireland, or household spending, has been weaker than people anticipated is the fact that households have a lot of debt, and over the last 4 years they've been running down that debt. You see from this chart the build-up in household debt in the noughties was quite sharp. We had at the peak of the boom, Irish households had built up over 200 billion in debt. And as I said, over the last 4 years, we've seen significant deleveraging, with debt reduced now to around 165 billion. That is still very high, though, relative to disposable income in Ireland. So consequently, it's very difficult to say when that deleveraging will stop. And I think it represents one of the big uncertainties about both mortgage lending in total and also the development of domestic spending in the economy. The net result of that is, of course, that net mortgage lending is actually contracting and has been doing so for the last 4 years. In other words, although there is new mortgage lending, and that is picking up somewhat, it's still being offset by the overall repayment of outstanding mortgage debt. So consequently, we can see from this chart that the change in net mortgage lending is still negative, and at the end of 2014 was still down something like 3% year over year. Given that contraction in credit in the economy, it's rather surprising perhaps that the Irish Central Bank is proposing to introduce prudential constraints on lending. Specifically, the Central Bank is proposing 2 ceilings, one in terms of 3.5 times loan to income, with 20% of loans allowed above that, and secondly an 80% loan to value ceiling, with banks only allowed to have 15% of loans above that limit. It's fair to say, I think, that the latter limit, the loan to value one, has received most attention, with the implication being, of course, that would-be house buyers will have to now save 20% deposit, meaning that probably they will be entering the housing market as buyers later in life than maybe would be the case in the past. The proposals have received a lot of comment, and most of it arguing that it will dampen down activity and perhaps adversely impact the supply of housing. And it seems at this moment that the central bank may be having a rethink. I suspect the proposals will ultimately still be introduced, but perhaps we may have a period of grace and until perhaps lending is growing more rapidly, or at least growing at all, before they're fully introduced. Finally, we turn to Irish house building nationally. We've already seen that in the case of Dublin, Irish house completions have picked up in 2014, and that's also the case across the country. This chart shows you annual house completions over the past decade, and you can see that at the peak of the boom, Ireland was building over 90,000 houses, adding 5% or so to the total housing stock, which is now around 2 million. House building subsequently collapsed and bottomed out in 2012 at around 8,000 units. As we can see, 2014 looks to be a little bit stronger. I suspect by the end of the full year data will show something of the order of 10,000, over 10,500 units were completed. That's obviously an improvement from the lows, but relative to prospective demand still implies a massive shortfall. Most studies would suggest that over the medium term, Ireland would require something of the order of 25,000 houses nationally a year. So clearly we're still not even at half that level. So the implication is that there's an demand and supply imbalance in general, and that will be a strong support for Irish house price inflation over the next few years. Well, that's it. We've come to the end of our presentation. Thank you for your attention. If you'd like any more information on the Irish economy in general, or comment on Irish economic data, including the Irish housing market, if you look up my website, www.danmclaughlin.ie, you'll find a lot more information there. Thank you.